Okay, I think Thomas just joined us as well. Here we are.
Here we are. Hello. Sorry, I was in and I was of the impression that you guys had already started, but that was just the prep session. So welcome to the second edition already of our multiple science panel series. We had the first one in Paris actually some weeks ago, and the idea behind this is there are multiple studies apparently that really help to drive returns in the private equity and venture capital space. And as you all know, in Paris we had the chance to present our very first Doriot Award for the best private equity research paper, and Ilya Strebulaev, who's here from Stanford University, was one of the winners, one of the co-authors of the winning team. And so we're very happy to have you with us today, Ilya. Welcome to this panel.
Thank you, Thomas.
And of course, Bernhard Schwetzler is with us. Bernhard, from our academic partner, is heading the Center for Corporate Transactions and Private Equity at HHL, Leipzig Graduate School of Business, our long-term academic partner. And we're very thankful, Bernhard, that you have accepted the role of, of a chairman of this multiple science panel, actually leading the discussion with Ilya here. And we discussed a lot the question of valuations today, actually, because inside the C19 scenario, the overall sentiment of our venture capital panel this morning was quite upbeat, I must say. They say, there are exit channels still in existence, a lot of them in the US. From the European perspective, that is a little sad. So we have only Amsterdam mainly for our IPO exit channels. And London is barred by some technical rules, I guess, to do more. And Frankfurt has some of the German IPOs. Of course, there are trade sales too in the area of venture capital, but IPOs are quite important. And the question was addressed, how are portfolio companies actually valued? Is there really sort of a bubble currently? We talk a lot about unicorns, $1 billion startups, valuations, but are those valuations inflated? What does science say actually? And so I would like to hand it over now to Bernhard and Ilya to discuss this very interesting question. Welcome again.
Okay, thank you very much for that. Introduction. Just pass on to Ilya, sorry. Go ahead. You got the first job.
Thank you, Thomas. And Bernhard, as the chairman, wanted me to go first. Yep. So first of all, let me confirm what was said is that the venture capital in the US is booming. I'm located here in Silicon Valley, and right now, I think the venture capitalists are here, and entrepreneurs as well are very optimistic. At the same time, the fact that venture capital is optimistic doesn't mean that we don't need to pay attention to valuations. And the world of venture capital valuation is very, very different. It's very different from traditional valuations. So specifically, there is a big distinction between the post-money valuations. This is the world in which venture capitalists live, and the fair valuation, the world of the stock market capitalization, and also the world of private equity. So many of my private equity friends go into venture capital and a bit surprised by the post-money valuation that they see there. Let's share my slides. I prepared a presentation based on the research that I've done with my colleague Will Gornall about the valuations of venture capital-backed companies. Can we start the slide deck now, please? Bernhard, do you see the slides? Because I don't.
I see the slide on the left-hand side. Yep.
Oh, I'm sorry. I don't see the slides. Okay. That's apologies for that. So
it's the title slide currently, so maybe we can move on to the second one. And Ilya, if you have a hard copy sort of or your screen, I can just indicate where we are. So please, team, put up the second slide then.
Right. So so
Oh,
basically,
there we go. There we have it.
Now I see the slides. Thank you.
Yeah, great.
Thank you. So let's go to the next slide, please. So now a number of years ago, my colleagues and I asked more than 1,000 venture capitalists about how they make decisions. In fact, this is the paper that Thomas mentioned kindly and that received the Doria Award. And one of the questions we asked about how unicorns, those highly valued private VC-backed companies, are valued, which is basically they are overvalued or undervalued. And we found that more than 90% of all the venture capitalists believe that unicorns are significantly overvalued or slightly overvalued. And no matter how you split them, how you slice them, you will see that they're all significantly overvalued. Now, that does mean that we can say by how much they're overvalued and why venture capitalists believe that they're overvalued. Basically, there was no methodology that allowed to understand what the fair value or the market implied value of venture capital companies is. So that's why my colleague Will Gornall and I developed a new methodology, a new valuation framework that allowed to value venture capital-backed companies. And this is the results that we got. Can we go to the next slide, please? So basically, we developed a methodology that is option pricing based. And we apply this to the way to value every single unicorn in the United States. Can you go to the next slide, please, to see the results of that? So what we, as you see there, what we found out is that each unicorn in the United States, at the time we valued it, which was 2017, 2018, was overvalued. Now, what I mean by overvaluation, that is very, very important because we need to avoid confusion here. This is overvaluation when we consider the post-money valuation relative to the fair value, meaning that let's say these unicorns would be traded on the stock market today. What would be their fair value? And then what is the post-money value referred to? Now, the reason why there's overvaluation, sometimes dramatic overvaluation of these venture capital-backed companies, is because the post-money valuation has a very peculiar equation, so to say, to achieve or to get to the number. So to get the post-money valuation, what you do is you take the price per share of the most recently issued preferred equity round and multiply by the total number of shares. Now that is results in overvaluation because preferred equity is typically has way more preferences than not only common equity, but also previously issued preferred equity. As a result, you multiply the price per share of one preferred equity by a large number of shares that have low value. And as a result, we also found that half of all unicorns lose their unicorn status. Can you please go to the next slide? Now, this result attracted a lot of attention. So we were on the front page of the Wall Street Journal and New York Times and so on. And it's good to report that in the United States, while venture capitalists, of course, knew that the post-money value overvalues relative to fair value, they didn't know how exactly to apply these valuations. So nowadays, there's a way to apply this. When we talk about mutual funds and other investors, either direct or indirect through the funds, they now have a methodology to apply to value unicorns. And also, our results suggested that we actually can predict the future, which means that if we say that unicorns are more overvalued, that means that they are less likely to experience good returns in the future, including they have a much lower likelihood of going public. Now, that was the original paper, the original project on unicorns. So since then, recently, Will and I extended this to a new framework. And now we can value every single venture capital-backed company, either in the US or elsewhere, but I'm going to show you the results on the US. Can you please go to the next slide? So this is an example of WeWork. Of course, a venture capital-backed company that is quite well-known, famous, and infamous at the same time. As you see the black dots, what the black dots show is the different valuations that are reported by mutual funds on the same day for the same share, which obviously is impossible if WeWork had been a market company. If you think about market listed company, because basically mutual funds say, one mutual fund says, well, the share is $50. Another mutual fund says exactly the same share is $30. So can we go to the next slide? Now, the reason what's happening here is now why we can now apply to all the companies is that we can take into account the exact payoff structure of every single security. So that what we do is we take the capital structure of the venture capital-backed companies, and this example is common, Series A, Series B, and so on, and we can allocate the payoffs to every single shareholder as a result of a specific exit. Can we go to the next slide, please? And what is really important in our extension of the original framework is that now we can accommodate future rounds, because venture capital-backed companies issue a lot of rounds. Again and again, SpaceX issued, I think, already more than 25 rounds of funding. And with every single round of funding, the allocation among existing shareholders changes. So if you're an investor in a venture capital-backed company, what you really want to do, you want to predict how the future is going to affect you. And that is what our new extension does. So let's go to the next slide. So let me show you some, let me go to the next slide. So let me show you some results of our paper. Let's go to the next slide, please. So this is the results where I took about 50,000 venture capital rounds, more than 15,000 venture capital by companies in the United States. And I measured the valuation or overvaluation, so post-money relative to the fair value of every single one of them over many, many years, starting from 2005 till today. And we find that the resulting overvaluation is about 50%, which is very substantial. There's one interesting finding, which I really like, which is really interesting, is that overvaluation declined over the last 15 years, from about 60% to about 40%, which is a very substantial decline. Why is that the case? The reason is because at least in Silicon Valley and other US regions, the contractual terms for early rounds became much more standard. You know, when I came to Stanford in 2004, multiple liquidation preferences were very common. These days, they're very uncommon. And the more standard the contractual terms are, the more likely we will end up in a situation where the overvaluation is lower. Let's go to the next slide. And so what it's shown here is that on the top, you'll see the standard. So if you have a standard contractual term, that there will be not a lot of overvaluation. There will be some always, again, because preferred equity is more senior to common equity. But if you have terms such as senior, participating, high liquidation multiples, dilution, and so on, then overvaluation can be dramatic. Specifically, if you're an investor in venture capital or thinking about to invest, high liquidation multiple is something that you should particularly care about. If you have 2 or 3 or 4x in late stages, then the overvaluation can be absolutely dramatic. In one of my companies that I looked at, my data said the overvaluation was more than 1,000%. Let's go to the next slide. Let's go to the next slide, please. And let's go to the next slide. Let's go to the next slide, sorry. Now, there's something else that I would like to show you, which I think is really interesting. In venture capital, because there are new rounds issued all the time, the rounds typically can be classified as up round when the price goes up, the down round when the price goes down relative to the previous round, and the so-called flat rounds, where the the valuation remains exactly the same. And what this shows, this graph, do you see a spike? So this huge spike, it shows the flat round. So basically what's happening is that there is a lot of cases, a dramatic number of cases among our thousands and thousands of rounds where the round is flat. So the valuation has not changed. The reason why it's the case, now we believe, is that those flat rounds are hidden rounds, which means the following. The actual fair value of a flat round is a substantial down round. But whenever there is, but by adjusting contractual terms, for example, by introducing multiple liquidation preferences, you can increase the post-money value. So basically, this is shows how it's easy to manipulate the post-money valuation. Let's go to the next slide. So my final slide is we're comparing our valuation results with mutual funds. I already introduced this to you when we showed WeWork, with the 49A values, which are used for regulatory purposes or for tax purposes. And then what is really interesting is the secondary market prices. So this is the green circles on this diagram. And what this shows is that, in fact, our model can predict secondary market prices really well. And today, because of the substantial increase in the secondary market trading in private venture capital by companies, and the reemergence of so many secondary platforms in which you can trade those shares, I think our model is going to be very useful, because basically you can see right away by applying our model whether the prices that are offered to you or your offering is under or overvalued relative to the fair value. So let me stop here, and Bernard, the floor is yours.
Thank you very much, Ilya. Thomas, you stop me if I exceed my time limit. Could you just go to my presentation and my slides? Okay, so we did something similar in a European context as Ilya's famous study, and we also find similar results. On average, we ended up with 20 to 25% overvaluation. So what I would like to talk to you is about the implications of this result. If you go to the next slide, please. Because our experience was quite sobering when we showed these results to investors, to the public. People did not seem to care too much about their importance. Yeah? And so I just have prepared some slides on who actually should care about these results. Yeah, the first who might be affected are entrepreneurs. Of course, I mean, they should properly value their stake on the one hand, and I mean, you also pointed this out, Ilya. I mean, this is a double-edged sword for them, because on the one hand, it's nice to be a unicorn because maybe it is going to propel your business case. Recently, we had a headline that Klarna, which is a financing unicorn, said that it prides itself to be the highest valued financial newcomer in the world. And of course, that's good. On the other hand, what we see, or what we see in our environment, is that especially startup teams are not at all aware and maybe get fooled by these simple and inflated valuation. So next slide, please. So the second ones that, and I copied this from your study, Ilya, the second ones who might be affected, negatively affected, are the employees, because I mean, I've witnessed the case where employees have been calculating the value of their stock option plan based on this simple post-money valuation, and at the exit, they all of a sudden found out that their stock option plan was close to worthless. And that, of course, is then, and they are usually not very familiar with option pricing theory and corporate valuation. And so, and that means that it is a wise idea to, in that sense, to make this calculation as an entrepreneur, and also to pass on these valuations to your employees. Yeah, because as I said, in the case that I've witnessed, that almost blew the exit of the entrepreneurs and founders. Yeah. So next slide, please. So who also might be affected is, of course, excuse me, the general partners of the funds. Yeah. And of course, I mean, we have shown our results to the GPs of the venture capitalists, and the least to say interest was quite limited to dig deeper into that. My view on this is that, my take was that many of them say, well, why shall we care for being very precise with option pricing models in the net asset value calculation if 80% of our investments have to be written down to zero anyway, and the remainder 20% will make us rich. So in that sense, why then care about this? And so they are quite also scared by the complexity of these models, and of course by the costs. So I mean, if we talk to them, then they say, well, is it worth the cost? Yeah. Do we have some additional benefits? Yeah. Next slide, please. So what we also find is that, of course, they may not even have an interest to introduce that. And I think that was also something that Ilya already pointed out, because there have been studies by some colleagues, especially Tim Jenkinson, who showed that there is, let's say, a danger or let's say a danger of overvaluation, especially when it comes to setting up a new fund and, of course, advertising the new fund, because in the fundraising period, of course, you have to show intermediate results and intermediate performance. And of course, if you stick to this net asset value calculation that is relying on real option terms, then of course you have to face the fact that maybe your valuations are lower, your net asset valuations. Yeah. So as I said, we are not too surprised that the interest of GPs, especially in the venture capital arena, was limited to introduce this. Please go to the next slide. So what about the LPs, the limited partners then? Well, here you see, I think that also was one of the famous cases in Ilya's study. That was the case of Square. So Square had a significant down round at the IPO, so to speak. I think their last round valuation based on the simple post-money method was 6 billion. And I think they went to the market at 3.5 or something like this. So LPs may, of course, have an interest on the proper valuation of their investment. But I mean, once they are in, of course, they are stuck in their investment. But next slide, please. They might be interested, of course, potentially before they actually invest. Yeah, because I mean, in these fundraising events, of course, intermediate performance is shown by net asset values. And of course, you, as a potential investor, of course, have a natural interest to, in that sense, to see net asset values that are not inflated. Yeah, and so that's also a picture that I picked out of Ilya's study. That was, and Ilya also mentioned this in his part, that sometimes you can avoid a down round, that is a financing round where the valuation went down compared to the preceding round, by simply increasing the special rights that you give this round's investors. Yeah, and the one case that you picked up here was SpaceX. They doubled the special liquidation preference in this particular round, and by doing so, again applying this multiple or this simple post-money valuation, they avoided the down round. Well, my lawyer advised me to say that of course there may have been other motives for them to double the liquidation preference in these special rights, but in the end, the effect was, of course, that this simple valuation method did not indicate a down round. Yeah? So next slide, please. So the group that we actually started to advertise the results of this model were the accountants, yeah, because I mean they have to certify the net asset values, and the regulations, IPEV regulations, have been changed, I think, in 2018, and the guidelines for valuation require them to take these special cash flow rights into account. Yeah. On the other hand, these regulations are rather vague, except ICPA. So these regulations of the US CPAs are quite extensive, whereas the IPEV regulation, that is, in that sense, the regulatory body and the regulatory framework for valuing or calculating net asset values in general in the private equity industry, in Europe, they are rather vague. They just require you to take this into account, but do not explicitly say how to do it. And so, whereas ICPA explicitly says in certain circumstances that you have to apply real option models. Of course, this is the most sophisticated way to arrive at these valuations. So we have been talking to the German CPAs. They sent us to the German BaFin, that is the supervisory authority for the financial markets. They sent us back to the CPAs, and so it was some sort like a round robin. We're still trying to advertise what we have found, as I said, our experience was quite sobering with public interest with respect to this result. Yeah. So next slide, please. So as I said, this is the regulatory framework, and the accounting standards would require the net asset value calculations to take these special rights. And it's not just about liquidation preference, it's also about these catch-up rules that you may have in down rounds and these ratchets and the like. So that becomes, at the end of the day, pretty complicated, and that also may be a reason why these option pricing model have not yet become standards on that. Okay, next slide, please. So I'm already almost through. Well, we went a step further and analyzed what factors actually drive the overvaluation. And well, this is not too surprising. You see on the left-hand chart, up left, you see that the number of rounds is, of course, important. That means early rounds are heavier affected than later rounds due to the mechanics. We also found that the contract features strict seniority where against pari passu regulation, and clauses have an impact on the degree of overvaluation. The number of down rounds, the lower the number of down rounds, the higher the overvaluation. And finally, you always have to introduce an IPO probability to your calculation, because usually when an IPO is the exit, then all these special rights have to be waived, and everybody is then treated equally. And of course, then a higher IPO probability yields a lower overvaluation in our model. So finally, just please next slide. I just would like to point out a model that my colleagues on this paper have pushed research a bit further and developed a regression model based on these impact factors that we thought might be helpful for funds to have a quick and dirty analysis on whether this is a deep problem, the overvaluation for them, or whether they may ignore it because it's not that big, without digging deep into their portfolio. And I just would like to point out that the model works quite well. And so if someone is interested, of course, I would be happy to pass this paper on. Okay, so that was my part. Any comments that you would like to make, Ilya, or also Thomas, or the audience? I think that
yeah, Bernhard, before we come to that, maybe ask the poll question which we have for our audience here. I could do that. So the question would be, do you think accounting standard for net asset value determination should strongly rely on option pricing models? Yes or no? So that would be the first polling question. And then the second one, by how much do you think unicorn valuations are currently inflated in percentage points? Firstly, not at all. Then secondly, maybe around 15%. Thirdly, around 30%. And also the audience, happy to get your questions, and I can then put them on the agenda. If I may, maybe a little bit of more background from the two of you. I believe from both papers, you know, I take that more standard contractual terms. Firstly, inside the Series A particularly would serve well in getting more realistic values. And Ilya, you mentioned that there is in fact a tendency not only in the Silicon Valley, but mainly derived from there, to actually agree to more standard terms. But let's maybe create a larger picture here. So we have a VC, a seasoned VC, right, has a 6th generation venture capital fund and is really savvy by now. And not only in playing the IPO game, but also really in terms of operational experience. So he would be looking at 1,000 potential portfolio companies, would be selecting 7, 3, or whatever. So those then are quite capable, you know, even young entrepreneurs, we hope. And it's all a bit about the fantasy in the VC game. I think we have to accommodate that fact too. So there's the VC that invests, you know, $1 million. It's really a seed investment maybe, but with the expectation, you know, spray and pray, we said earlier, investing a number of portfolio companies that one will eventually make it. And I think if we look at the parties involved in the game, where's the real interest probably to move on to real options valuation models? We had this discussion, I think, then I really took it from the newspapers. 10 years ago, there was a huge discussion about real options, and eventually that didn't materialize. So if we look at the parties involved here, we have apparently the GPs, and we remember this discussion, you know, of lockup periods. So I really remember that discussion that was with Kleiner Perkins, I believe. How long will you stick to your investment post IPO, meaning that you don't take green shoe and then don't take away the high valuation, but leave something on the table for all investors and retail investors as well. So if, again, now towards a question actually, if we look at the parties, where is really the barrier here? Where is the resistance? I believe, I mean, BaFin, Bernhard, you mentioned it, or the SEC, they would do everything that leads apparently to fairer trading and fairer judgments. And I think the accountants, yes, they want business from VC, GPs, yes, but it's not really about them, I guess. To oppose to standardization, that's business too. So probably the VCs wouldn't like to see cut in their valuation. And now towards the question, I think LPs share fantasies, share visions. You know, you talk about SpaceX. So if we, all the three of us, assume that we would go to Mars for $100,000 pretty soon, and that this is a realistic option, what can we do other than pushing this company by maybe assigning part of a visionary valuation? So I think the potential resistance of VC GPs in accepting lower early round valuations is not really attacked by LPs, because they share them. So how can we come around that to make it a workable model? I think it was a lot that I said, but I think it really leads to this question. But because there's the regulator, that's fine. I mean, it's not criminal business here. We just say the valuations are sometimes really significantly too high, particularly in early rounds when there are too many preference, right? How could we give LPs a better deal, the broad base of LPs, that is, without, you know, cutting away too much in return potential for serious lockup period accepting VCs?
So maybe I can take it, if that's all right. I'll try. I think you raised a lot of interesting questions.
Yeah, I'm sorry.
The question, the comment. Let me touch upon several, which I think are very, very important. The first one is that I think we need to be we need to distinguish between the contractual terms and the valuations, which is the contractual terms changed, not because people care more about valuations. The contractual terms of Silicon Valley changed over the past 15 years because of the change in supply and demand nature between the founders on the one hand and the venture capitalists or investors on the other hand. The tide might turn tomorrow, and if we're going to go into a recession, for example, from the technological point of view, then maybe the contractual terms will become again more friendly to investors and less friendly to the founders. And this will drive the overvaluation. So that's one point. The second point is that I think that I don't think we need to insist on contractual terms being such that it reduces overvaluation. What we really need is for investors to understand much more clearly, how to think about and how to calculate precisely the valuation. And I think that I really liked Bernard's presentation. Bernard's is a very interesting paper, and so I definitely would dive into it more. But one thing he mentioned is that venture capitalists care less about this because they say, well, many of our companies fail anyway. That I agree with. However, if you're an investor in venture capital funds, then you cannot take this, I think, approach. Because if you think about LPs, like I very often work with limited partners, funds of funds, sovereign wealth funds investing in, and trying to help them allocate their portfolio and trying to think about how to value their portfolio. So they cannot take this cavalier approach about, well, so many companies fail and so many companies succeed. They need at any point in time to know what the fair valuation is. So I think the real people who would benefit, real participants in the market who would benefit from this approach are not really the venture capitalists themselves, but investors in the VC funds. And so over the past 5 years, I've been working a lot with those investors. And now they appreciate more, not just that why the venture capital backed companies are necessarily overvalued, but also how to approach, how to estimate the fair value, and how it could be helpful in them making specific decisions about, for example, selecting a specific fund or participating in the secondary market transactions.
I agree. And I agree, it's not about, opposing anything or putting one party against the other. It's just about creating more tools, to come to proper valuation based on empirical wisdom, based on calculations and empirical wisdom, which is a good thing. And the only thing is there will always be, and there should always be, although it sounds a lot of, vision, fantasy, whatever in the VC space, if we would say, it's just an accountant's game here. Because on the one hand, we lament about less IPO channels in Europe and that no proper exit is possible. I think there should be a lot of music around it, but the orchestration should be more proper, maybe. And you two gentlemen did a lot of fine research in that direction. As always, further research is needed. That's what we always say in the paper. But this is a very good start, and I hope, that there will be fruitful discussions going forward, and that maybe in Bernhard, in Germany, we could put together a round table, this initiative that we have launched recently, VC2, to bring together institutional investors and GPs more on the VC end. There might be a good opportunity this autumn to have a panel on valuations that includes BaFin, that includes IDW maybe, in Germany, and maybe then come to results when it comes to opening up for other valuation techniques. So
may I just add one
yes,
final comment
sure.
on this? Because
when
we talk about valuation, I think that I have to pour a bit of water into the wine, so to speak. That is, unfortunately, these real option models do not solve the real valuation problem itself, because we use some sort of a backwards engineering approach and say that if the investment of the venture capitalist in this round is properly priced, then by backwards engineering we can tell what is the true value of the total company. And so still we do not yet have very good models to tell us what actually how the venture capitalist in this round shall arrive at his valuation. Yeah? So we simply assume that he will be able to properly price his share, and then based on this assumption, by a backwards induction, we solve the valuation problem of the whole company. So there is still, as you said, a lot of work to be done.
Yeah, I understand, the formulas might be as proper as they could be. Without the right input, it would be garbage in, garbage out all the way. So let's really work on better techniques over the coming month and years. And maybe if we resume our discussions, maybe within one multiple science panel, maybe next year or in 2023, maybe we have a bit of a better standard. It's all piecemeal work as always. So why don't I tell the audience the results of our 2 poll questions. So the first question was, do you think accounting standards for net asset value determination should strongly rely on option pricing models? 75% agree with that, so quite encouraging. And the second question was, by how much do you think unicorn valuations are currently inflated in percentage points? And only 8% would say not at all, around 15%, 17%, and 75% again would say, well, around 30% unicorn valuations inflated. So if I remember that probably, Ilya, that's still a conservative estimate of our audience. All right, so we made it, a brilliant panel, very lively discussions. That is multiple science. We really show that science adds to the bottom line and is very interesting. So thanks for being with us for this second round, Ilya. Congratulations again for winning the inaugural Dorio Award. Hope to see you maybe in Boston on September 15. I mean, we're still talking to Boston Harbor Hotel, which model would be suitable to meet, and you have the flight there from West Coast to East Coast, but maybe you can join us virtually then. Bernhard, as always, thank you very much, you and HHL. CCTPE for being with us as our academic partner for the Private Equity Summit Munich 2021, which is over by now. Thank you all. Thank you to the team, to Skills for putting this together in such a brilliant way with all the technicalities. When you are part of this team, you really know what these people have to do over days and weeks to come. Thank you, everyone. Looking forward.
Thank you so much for the invitation. Thank you.
Thank you.
Goodbye.
Thank you, Bernhard. And I hope to make it to Europe to be a speaker at your European Summit. After more than a year, I can't wait until Europe opens up.
Oh, that's fantastic. So we welcome you either in Paris, in Munich, or in both. Thank you, Ilya. Absolutely. That sounds great.
Bye for now.
Goodbye.
Bye.